Are liquidity pools taxed in Australia? Welcome to the educational series, Unraveling Crypto Tax in Australia by Crypto Tax Calculator. I'm Patrick, and I'm here to break down the complexities of crypto taxes in Australia, so you can file with confidence this tax season. Liquidity pools are made up of one or more assets held in a smart contract that facilitates a variety of decentralized peer-to-peer financial transactions, such as swapping, borrowing, lending, and other forms of trading. Liquidity pools form the backbone of many decentralized protocols. Without liquidity, many would simply fail to work whatsoever. Due to this, projects are constantly competing to attract liquidity to their platform. The more liquidity they get, the more robust and usable their platform becomes. Many projects will use a multitude of methods to incentivize people to provide liquidity to the platform. These incentives are often in the form of fees generated by the pool, plus token rewards from the protocol. Liquidity pooling is still a grey area in terms of tax, so I'm going to break down the possible scenarios and how they could be treated for tax purposes in Australia. If the protocol gains ownership of your liquidity when you provide it, this could potentially be seen as a disposal, triggering a capital gains tax or CGT event. The exact tax treatment would depend on the precise details of your interaction with the protocol. Let's take a look. Example 1. You own 3 ETH worth a total of $1,000 and the same value in stablecoins. You deposit both the ETH and the stablecoins into a liquidity pool to earn rewards. You receive a receipt token, also known as an LP token, that has no market value and cannot be traded. In this specific example, you remain the owner of the ETH and stablecoins. At some time in the future, you withdraw your ETH and stablecoins from the pool, along with some token rewards you earn for being a liquidity provider. These tokens are worth $200 at the time you receive them into your wallet. This $200 will be ordinary income and subject to income tax according to your marginal tax rate. Example 2. Using $2,000, you buy 3 ETH and 1,000 stablecoins. 1 month later, you deposit both the ETH and the stablecoins into a liquidity pool to earn rewards. The combined value of the ETH and stablecoins is now $2,500. In return for the deposit, you receive a receipt token, except this token does have a market value and can be traded at any time. In this specific case, you have disposed of your assets in return for the LP token. This will trigger a CGT event. To calculate it, take the capital proceeds, $2,500, minus the cost base, $2,000, which would give a capital gain of $500 in this case. At some point in the future, you decide to use your LP token to withdraw your liquidity from the pool. You're also entitled to withdraw additional tokens as rewards. Therefore, you are A, disposing of your LP tokens and need to consider whether you've made a capital gain, and B, receiving reward tokens and need to declare them as ordinary income. Broadly, to calculate any gain on the disposal of an LP token, you need to know how much you originally paid for them and identify how much you received for their disposal. You originally acquired the LP token by exchanging your ETH and stablecoins. Their market value was $2,500, so that's the acquisition value of the LP token. You dispose of the LP token when you exchange it back into ETH and stablecoins. The new value of the ETH and stablecoins is $2,300, which is less than when you deposited them. Therefore, you have a capital loss of $200, which can be used to offset current capital gains. Or where there are no capital gains, these losses can be used to offset future capital gains. Your ownership of the ETH and stablecoins has reset, meaning that you'll only be eligible for the 50% CGT discount after holding them from 12 months from this point. Similarly, if you held the LP token for more than 12 months, you would also be able to access the discount for any gains. As you can see, it can get pretty complicated when it comes to figuring out taxes for liquidity pools. Crypto Tax Calculator was built from the ground up to handle complex on-chain activity like liquidity pools. So if you need help, head over to cryptotaxcalculator.io to sort out your tax nightmare. Keep watching Crypto Tax Calculator series, Unraveling Crypto Tax in Australia, to learn more about how crypto is taxed so you can file confidently this tax season. In the next video, we'll answer, is lending and borrowing crypto taxed in Australia? See you in the next video.